Today we're here to talk to you about something that is monumentally impactful for anyone who is a current homeowner or someone who's thinking about becoming a homeowner in the not too distant future. This is Resource Real Talk About Real Estate, and I'm Jay Pitts, broker owner at RE/MAX Premier Properties. On December 22nd, Congress passed a comprehensive piece of legislation known as a tax reform. Basically, as I see it, there are three main topics that all homeowners or soon-to-be homeowners should focus on. Number one is the capital gains exemption. It was proposed originally that when selling your primary residence or a second home, that the capital gains exemption, exempt from the capital gains tax rate on the gain from that sale, was to go from 2 out of the last 5 years of owner occupancy to requiring now 5 of the last 8 years of owner occupancy. That did not make it into the final bill, and it's a good thing because it could have been disastrous for homeowners, specifically those that had bought low in the last 5 years and rode the good market to good appreciation. It's a great thing that that didn't make it in, and I expect that our market will continue to rise because of it. Now, number two is the mortgage interest deduction. Now, mortgage interest has always been deductible. To the tune of up to $1 million in paid interest on a primary residence or a secondary residence alike. It was proposed in the original or even the reconciled bill that would be switched to $500,000. Now, it was ultimately kind of agreed upon in the past piece of legislation to meet in the middle at $750,000. So, to put that in perspective, okay, only about 4% of homes that sold last year in the greater Louisville area were greater than $500,000. Obviously, to have $500,000 worth of equity, you have to be at least worth $500,000. So this is part of the tax legislation that you may hear in the national media. You may hear people talking about the fact that it changed and think it might have a negative impact on home values. Truth is, only up to 4% of people would even possibly be affected by this change to the tax code. Now, number three is state and local property taxes. State and local property taxes have always been deductible against your income tax for properties that you own or occupy, as your primary residence or a second home. Now, in the proposed bill, at one time, these were to go away completely, leaving people that paid a lot of property tax a little uneasy, and ultimately it was settled that $10,000, the first $10,000 of taxes that you pay on your property's first primary residences and second homes will remain deductible. Now again, on a national news cycle, on a national scale, in areas in New England and the West Coast and maybe even Southern Florida, where property taxes are much higher, you're going to hear this as something that's complained about. Truth is, here in greater Louisville, just 1% of homes sold last year would be affected. At our current tax rates, your home would have to be tax assessed at least $770,000 to eclipse the $10,000 mark that you're allowed to write off. Now, you may want to consider the fact that if you own a lake house along with your primary residence, that $770,000 is going to be divided between two properties. But even then, a very, very small percentage of the population will be affected. Now, those are the three main topics that I see. Again, capital gains exemption, mortgage interest deduction, and state and local property taxes. One thing I should probably note is that if you're an investor, you can still write off all your interest on your investment property. You can still take all your property taxes against the against the revenue generated by that investment. And there is actually a few other notable changes for investors that we are a little too lengthy and complicated to get into today. However, I will say that all sources that I have looked into, discussed with both locally, regionally, and nationally say that this particular passage of legislation is a huge win for real estate investors. Now, if you'd like more information about that, I have to tell you I'm not a CPA and I'm not an attorney and I can't legally provide this type of advice without recommending you reach out to a good CPA. But if you would like to talk to us more and understand the implications for your portfolio if you are an investor, please reach out to us. Please reach out to us. We want to be your resource for everything real estate related. And we really appreciate you tuning in today. Reach out to us via any of our social channels or click the link in this video. We look forward to talking to you next time. Thanks.